Thank you all for joining. We're going to be talking in this webinar about buying a home with student loans. And so student loans has been a hot topic in the media, it's been a hot topic politically, just in general, because student loans weigh a lot of people down. And for a lot of people, it prevents them from being able to advance further on in some of the things that they want to accomplish, such as purchasing a home. Which is one of the biggest purchases that most people will have in their life. So we're going to talk a little bit about how you can decrease the amount of debt that's calculated for your student loan, as well as how loan officers calculate your student loans, how we view your student loans when it comes to applying for a mortgage, to just give you some information that can better help position you for what you're trying to accomplish when it comes to purchasing a home. So, figured I'd start out with something a little bit humorous. Someday all of this will be yours. It's I guess a laughing matter, but in this country, we know that debt is a huge thing, not just the national debt, but also, individual household debt is just something that continues to just increasingly climb. And so hopefully this will be a webinar that will help shed some light on some ways that you can kind of navigate this mountain of student loan debt to be able to purchase a home and invest in something that's going to appreciate over time. So, how much home can you afford? The simplest way that I can put it is half of your monthly income minus monthly debts. That is how, at its simplest form, we calculate the amount of home that you can afford. So, what does that mean exactly? Let's say that your income is $4,400 a month. Divide that by two, i.e., half your monthly income, and you get $2,200 a month. So there is going to be a lot of math in this webinar, but I try to keep everything simple, try to keep the numbers and concepts simple so that you can follow along with me and gain value from this as well. So again, $4,400 a month is what we make, half of our monthly income. So 4,400 divided by 2 is 2,200 minus your monthly debts. So those monthly debts that we're going to start subtracting out is your car payment, your student loans, your credit cards, and your personal loans. So I've got a thing on my screen. I'm going to see if I can move it to a different area. I'll move it up here. All right. So subtracting out our monthly debts, car payment, student loans, credit cards, personal loans. And once we subtract out all of those debts, what's remaining over is how much we can actually qualify you for your mortgage. So that is how we in the mortgage industry as lenders calculate how much home you can actually afford to qualify for. Now, this is based on what we will call a 50% debt to income ratio. How we get that is 2,200 is 50% of your gross monthly income. So if your gross monthly income is 4,400, obviously your take home would be less than that. Your take home would be 3,000 and something. But if your gross monthly income is $4,400 a month, half of that is 2,200. And if half of your income goes to paying out, goes to car payment, student loans, credit cards, personal loans, and your mortgage payment, then that's a 50% debt to income ratio, or DTI for short. So that's around where you want to shoot when you're looking to purchase a home, just because there are some programs such as FHA where you can go above 50%. However, that also depends on your credit score needing to be good for you to be able to get above 50%. But 50% is a good place for you to try and aim and shoot for. For the purposes of the remainder of this webinar and this presentation, we are going to use a 49% debt to income ratio, not a 50, so slightly less. The reason is because when you qualify for a conventional mortgage, a conventional mortgage will not give you an approval above 50%. You can get a 49.99, but if you go 50 and up, you cannot get approved under a conventional loan, and that's through Fannie Mae or Freddie Mac. So again, we are going to use the conventional standards for the remainder of this presentation, and also because 50% is a better place to be rather than trying to push the limits to get up to 52 or 56 under an FHA. So 50%, 49% is what we're going to be aiming for, utilizing for the remainder of this presentation. So how do lenders calculate your student loans? All student loans have to have a payment associated with them. So a lot of student loans are in forbearance or in deferment right now, I should say. And so people have not had to pay on their student loans for years. When we pull credit reports, if your loans are currently in deferment, it shows as zero for the monthly payment. However, in the mortgage industry, we have to calculate a payment for those student loans. You might be thinking, well, my loans are going to be forgiven at some point, or, the government. We don't operate that way in the mortgage industry. If there is a balance listed, we have to have a payment associated with that balance for those student loans. And so the way that we calculate that payment is that for example, if you have a $50,000 in student loans, we take a 0.5% of the outstanding balance, and that is what we calculate as your monthly payment. Now, depending upon the loan program that you use, it could be more than a 0.5%. For example, if you're using Fannie Mae's desktop underwriter, you could have to calculate a percent of the outstanding balance, which would be higher. I normally go off of calculating a 0.5%, and I try to qualify you under an FHA or under a Freddie Mac, where we can use the 0.5% standard to qualify you without having to add more of the debt with the percent. But this is how that looks. If you have $50,000 in student loans, multiply that by a 0.5%, $250 is what your monthly payment is that we calculate for your student loans. So how does that affect you? If your income is $4,400 a month, we subtract out $300 in debt. Now, utilizing $300 as a number. Let's say you don't have credit cards, you don't have student loans, and you just have a car payment that's really low and it's only $300 a month. So we'll say that's your $300 in debt right there. Now, again, remember that $300 gets subtracted from $2,200, not from $4,400. As I showed you in the previous slide, you got to divide that 44.5 first to get that 50% debt to income ratio, and then we start subtracting out the debts. So that we subtract the $300 in debt, and to get us at a 49% debt to income ratio where we could qualify for a conventional mortgage, that means that the maximum purchase price that you could purchase for a home would be about $240,000. Now, if you want to know how that $250 monthly student loan payment would affect you, let's add in $250 in student loans per month. Now, to get that same 49% debt to income ratio, we have to drop the purchase price of the home to $205,000. So that's $35,000 worth of purchasing power that we can no longer have just because of that $250 student loan payment that we have to pay. So sucks for this lady, sucks for the home buyer, sucks for me too, because I want people to be able to purchase a home that they're going to be happy with and pleased with and feel good about. So moving on, income-driven repayment. This is one way that you can decrease that student loan payment. So what an income-driven repayment is it looks at how much money you make, your income, and it calculates your debts, how much stuff you owe and other bills and other debts and everything, and determines what your monthly payment should be based off of what your income is, not based off of the 0.5% that we're going to calculate for your student loans. In many instances, this income-driven repayment, also known as income-based repayment or IBR, oftentimes is lower than what we would have to calculate. So let's use our same example. The $4,400 a month is our income. Subtract out $300 in debt, 49% debt to income ratio gets you a $240,000 max purchase price. So with the income-based repayment, let's say that that same $50,000 in debt based on your income situation, let's say that it's determined that you only have to pay $50 in student loans instead of $250 in student loans. How does that look? And so basically now, to keep that same 49% debt to income ratio, we have to drop the purchase price $5,000. So now we're looking at 235 instead of 240, but we saved $30,000 worth of purchasing power just by doing the income driven repayment instead of just using the 0.5% of the outstanding balance. And this is what I really try and get home buyers to understand, especially if they have a lot of student loans, is that how much we have to calculate with the 0.5% of the outstanding balance when you get 50,000, 75,000, 100,000 plus in student loans. That becomes a large amount of money that we have to calculate for your debt. And if you don't make a lot of money, then that can really put a dent in how much you're able to purchase on that home. So utilizing that income driven repayment really can help you when it comes to purchasing a home and not having to drop the purchase price that much to account for the debt for the student loans. Now, I know some people also, I've had people caveat me by saying, but now they have to start paying on their student loans. Yes, you would. If you do the income driven repayment, there is a payment listed and you will have to start paying on that, whereas a lot of people right now are not paying on their student loans. If it comes to purchasing a home and paying $50 a month on your student loans, for this example, it's better for you to pay the $50 a month and purchase the home, because $50 a month is something that you can do by making cutbacks in how much Starbucks you drink every month, or making cutbacks in other areas. Maybe you don't go out to eat at restaurants as often. Maybe you scale back on one of your many subscriptions that you might have to a streaming service with Netflix and Hulu and Disney Plus and everything. There are a lot of different ways that you could come up with $50 or $100 to be able to make that payment to afford you the opportunity to purchase a home. And purchasing the home is an investment that's going to appreciate over time. And so I think it is a much better investment to actually do the income driven repayment and pay that amount that you would have to pay for the income driven repayment in order to be able to purchase a home, which is a huge investment that's going to pay dividends over the coming years or decades, however long you end up staying there. On average, your home appreciates at 2 to 3%. Atlanta is actually projected by the National Association of Realtors in an article that I read to have an appreciation of 5% this year. But even if we're sticking at the minimum with a 2% appreciation for a $200,000 home, that comes out to, I want to say, let me put it in the calculator really quick just to, yep, that comes out to $4,000 for the year for a $200,000 home. So 5,000 if you're looking at a $250,000 home. And so $5,000. Now, if you were paying $50 a month on student loans over the course of 12 months, that's $600. If you were paying $100, that's $1,200. But your home is appreciating at 2%. A $250,000 home has gained $5,000 in equity in 1 year when you only had to pay, 600 or $1,200 on your towards your student loans. And that asset that you have in a home is going to continue to appreciate. So I'll get off my soapbox a little bit, but just to paint the picture that I believe it is definitely worth the investment to start paying on those student loans if it's going to afford you the ability to be able to purchase a home. So talk a little bit about a tale of $200,000. So on $200,000, what we would have to calculate, the 0.5% comes to $500 a month for your monthly student loan payments. If you did $1,000, 500 would be off of $100,000. So it'd be $1,000 a month, excuse me. So for a $200,000 student loan debt, we have to calculate a monthly payment of $1,000 a month. That's the 0.5% of $200,000. If you were to do an income-based repayment, it is possible that you could drop that $1,000 all the way down to less than $250. That's less than a quarter of what we would have to calculate if you don't have a payment listed at all. Now, this is actually coming from what I've actually seen in real life from a home buyer who had in excess of $200,000, but was able to do an income-based repayment and get that reduced to less than $250. And it immediately took this home buyer from being able to not purchase a home, or from not being able to purchase a home, to being able to qualify, get approved for a home, and actually closed on that home earlier this year. So again, 200,000 is, a lot of student loan debt, but even that does not have to be something that stops you from purchasing a home if you navigate correctly and do the income-based repayment, or you look at some other methods that you can use to also reduce other debts if you're not wanting to start paying on those student loans. But again, paying less than $250 a month towards student loans to afford you the ability to be able to purchase a home is something that I believe is a good move to make, and will definitely pay off in the long run. So how do you apply for an income-driven repayment plan? Google. If you would Google income-based repayment or income-driven repayment, you will see a studentaid.gov website pop up at the top. And that is the website that you can go to learn a lot more about the different types of income-driven repayment, because there are 4 different types of income-driven repayment plans that you can utilize to reduce how much you would actually have to pay back on your student loans. And again, they're all based on your income level. So wherever your income level is at, that's what they look at, in addition to the debts and stuff that you have to pay, to determine how much your payment will be every month for those student loans. And again, a lot of it's not based on even your interest rates for these student loans. I've seen a lot of times where the income driven repayment amount is not even enough to cover what your interest rate is, but it's how they calculate it with the federal loans. And so if you Google that, and I felt it was better to just have you Google these rather than me put up the long website and then you try and copy that down. Just Google income-based repayment or income-driven repayment, and you will see at the top of the search results where you can click on that studentaid.gov, and that will take you to the federal site where you can learn a lot more about it and apply for that income-driven repayment as well. So with that, that concludes what I was going to talk about. Before I get into a little bit of something else, I will see if anyone has any questions or anything first. So does anyone have any questions? All right. So if not, I'll also tell you a little bit about a personal story with me. So I also have experienced the student loans in excess of 6 figures. I will put it that way. So when I married a very ambitious wife who was in the works to get her doctor's of physical therapy, and she's great at what she does, but a doctor's of physical therapy is not a cheap degree by any means. And so at the end of it all, we ended up having it was a little over, not a little over, about $115,000 worth of student loan debt. And I was very much so against debt. I'm not a huge fan of debt, other than having a mortgage, because that is secured by an asset that appreciates over time, and that as you pay your mortgage payment, you also put equity back in your home. So other than a mortgage, I'm just not a huge fan of debt. But my plan going forward was to get that paid off as soon as possible. And what at least my strategy was that all of her income would go towards paying off her student loans, and my income would go towards taking care of our living expenses, and we would live very, very meagerly, very frugally, so that we could get this thing knocked out in 2 years. It didn't happen in 2 years. It took more like 6 years, but we got it taken care of and got it paid off. And the reason that I mentioned that is because being able to have that paid off really helped us out a ton when it came for us to purchase our second home. So our first home that we purchased was actually while we still had the student loans. But the second home that we purchased, we still own the first home that we purchased and we're renting that out. But the second home that we purchased and being able to qualify for that because we were able to get those student loans paid off, that was something that we did not have to calculate in terms of a debt that would go against us and hurt how much home we could qualify for. So we were able to get a nice home that we plan on staying in for the next uh, couple decades because I am prior Navy. I did 7 years in the military, and so we moved around a lot. And yeah, we're both kind of ready to just settle down and not be moving around here and there so much. So I mentioned all of that to say that even if you're not in a position to be able to pay off your student loans, or you don't want to wait the 5 or 6 years or however long it might take for you to come up with the plan or the money to be able to pay off those student loans, you can still have the similar effect of having your student loans paid off by doing a income driven repayment plan. Because as you saw in our example previously, it took you from, with no student loans, you qualified for a $240,000 home, to now doing an income driven repayment, going from 250,000 or $250 that you would have to calculate for that student loan payment down to $50. And that's a fifth of what you would actually have to pay. So if you're wondering, well, is that actually possible? It is, because like I said with the previous example before, the individual that I knew who had in excess of 200,000, the monthly payments for their student loans was in excess of $1,100. So to be able to get that from that amount to below $250, the amount that they were able to get it to was about 20% of what it would have been if we had to just calculate what the student loan would have been under the Fannie Mae, FHA, or Freddie Mac guidelines. So when we come up with how much we have to calculate, that amount is not something that we're just pulling out of thin air. These are all according to the guidelines that we have to originate these loans to. So by her being able to just take a fraction of what we would have to calculate, now that individual was able to qualify for a home and close on it earlier this year. So that is about all that I have. Does anyone have any questions or anything? I know it was short tonight, but I wanted to just put out some good information because I know a lot of student loans and everything is something that, um, as a loan officer, I see prevents a lot of people from being able to purchase. And I try to inform everybody that I come into contact with. You can purchase a home. Your debt to income can be a lot lower if you are okay with paying towards your student loans under an income driven repayment plan, so that you can reduce the amount that we would have to calculate for your student loans. Um, for some people that works, for some people they don't want to pay on their student loans. That's a personal choice. I'm neither here nor there on it. I just like to put out the information to inform people on what their options are and let them make the best decision from there. All right. Well, if there is no one that has any questions or anything like that, I want to thank you again for tuning in. Again, I'm Frederick Middlebrooks. This is my contact information. As you've seen, I put out videos at least 2 or 3 a week on social media. I'm pretty active on Instagram and TikTok, also on LinkedIn as well. So GA Loan Officer, GA for Georgia, which is where I'm from. Um, GA Loan Officer is where you can find me at on Instagram and TikTok. Uh, LinkedIn, I'm just Frederick Middlebrooks. And yeah, if you ever need any assistance, I would love to help assist you in qualifying for a mortgage. Or if you just want information, if you have a lender, but you just want information on different ways that you can structure a deal, because this is just one of the many ways that you can reduce how much debt you have to pay, or how much debt has to be calculated on your loans, and how you can increase the purchase price. And I'll mention that really quick because I didn't go over that. So there's more than 3 main ways that you can increase the amount that you qualify for in terms of the amount of home that you purchase. One of those is by reducing your debt, as we showed here, a way that you can reduce your student loans, but also paying off other debt is one way that you can increase how much home you purchase. Another way is by earning more income. Um, and another way is also you can buy down your interest rate. Your interest rate determines a lot with being able to how much your monthly payment is going to be. And so the examples that I gave here for the 240,000, 230,000, these were all based off of a 6% interest rate, which is a very attainable interest rate in today's market. So depending upon what interest rate you have, or how low you want to buy it down, can also help buy you a little bit of purchasing power as well. However, the best way to get more purchasing power is to pay off debt. That is the quickest way, with the smallest amount that you can do that will have the biggest impact, is paying off debt. And especially if you have, say, some credit cards with $1,000 limit on it, or charge cards that it's showing on your credit report that you have $150 a month payment. Eliminating that can do a lot for being able to help you with being able to qualify for more home. I have seen $400 have a $70,000 impact on someone's qualification range. And so again, having $400 of debt, which in most people, to a lot of people, that's a car payment. Having $400 can impact you $70,000 in terms of how much home you're able to qualify for. The difference between you qualifying for a $280,000 home and a $350,000 home could be that $450 car payment that you have, or that $500 car payment that you have. That payment, seemingly small, 400 and 500, impacts your debt to income ratio that much that it can move the needle 70,000, 60,000, $80,000. As you saw in our example, even just adding a $250 student loan payment costs $35,000 in a reduction of the price. Adding a 400, 450, $500 car payment can mean that you qualify for $70,000 less in a home. And so that's something that you definitely want to be aware of as well, so that um, before you make these purchases or take on these debts, I always tell people, purchase the home before you purchase the car. If you already have the car, or if you need the car to work, absolutely get the car so you can get back and forth to work. But if you can purchase a used car and just pay cash for it, where you do not have to take on that debt, purchase the used car and take on the and pay cash for it, so that you can purchase the home, get that home that's you would really like, that's gonna maybe cost you $50,000 more, and then leave the closing from that home, go straight to the dealership, and you can get the car that you really want, because it is so much easier to purchase the car than it is to purchase the home. So purchase the car that you want, or excuse me, purchase the home that you want, buy the car used that you can pay cash for if you're able to just make do until you get the home secured. And then once you get the home secured, you can leave the closing, go purchase the car that you really want, and that'll be a much better order in which to do those things, so that you don't have to take that 50, 60, $70,000 hit to how much home you can qualify for, because we have to calculate a $400, $500 car payment. So thank you all for tuning in. I greatly appreciate you taking the time out of your day